All right, it's time to deep dive the Federal Open Market meeting. The Federal Reserve yesterday on the 29th of July is when they held this meeting. So we got these meeting minutes yesterday. And interesting because the market dipped quite a bit yesterday because of just one line inside of these meeting minutes about the uncertainty of the market. And look, the power of the Fed, they have the power to move markets just with a few short words. So why this is so important, it really provides us a forecast of where we're going in the economy. Where does the Federal Reserve see us over the next 6-12 months? Very, very important. Also, are they going to keep interest rates near zero or at zero so that the market continues this upward trend? What will they need? What do they need for stimulus? How much more additional stimulus will they provide to businesses? How much more liquidity into that market? Will they push Congress to push for additional stimulus? So all of those things were answered yesterday in this Fed meeting minutes. Now it's 13 pages. It's a lot. I spent quite a bit of time going through it, reading line for line. So you can read it right off of their website. But it's very important to go through all of this and digest this and go back. So going back and making highlights and notes on this. One of the big takeaways that I took from these meeting minutes is that the uncertainty remains strong, specifically in the leisure and hospitality, and it's going to struggle for some time. I mean, we're certainly seeing this as people are, deciding not to travel. Another thousands of hotels are set to close. Jobs are set to be lost in that hospitality industry. That was the area that's hit really, really hard. And other officials also discussed during this meeting this outcome-based forward guidance and using specific targets on inflation and unemployment before raising the rates again. So what does that mean? What is in layman terms? What exactly does that mean? That just basically means, are they going to have certain points of light along the path that they'll say, okay, certain targets that we want to hit? Unemployment at 8%. Unemployment at 6%. We've heard that number floated before, that if we got to an unemployment rate of around 6% or 7%, maybe we would increase rates based on that scale. So would they be looking at this sort of outcome-based approach to raising rates, therefore trying to act as a buffer against inflation? They're the bellwether here. And that rate that they set is the rate that everything else is based on. Mortgage rates, everything else. Right? It's that benchmark rate. They have the power to change the world with one simple little movement. And that's why I think we've been calling on them. Can the Fed step in here and pass some form of stimulus? Because they have the power in a way that Congress can't seem to get their act together to do. So let's go through these meeting minutes now. I'm going to highlight a couple of key areas that I took away from this. I'm going to be scrolling through here. So I want to go down to page 3. It's kind of the first area that I wanted to highlight here and talk about specifically the recovery. I mean, we go over here where they're talking about the S&P 500 doing very well, but they're also talking about virus-sensitive sectors. And this is important for people who are investors in these areas, like airlines, hotels, who were taking, they were taking bets that these things would recover. I mean, American Airlines has just been hemorrhaging, but what they're saying is you need to be careful here, that the airline and hotel share prices declined sharply, and this is going to it's going to continue to have problems. So if you're putting your money in these types of stocks right now, or you run a business like this, the headwinds are still strong, and we could see big problems for years to come. Another area that I thought is interesting, I've been covering repos here on the show for quite a while, and what that is the Federal Reserve repurchasing outstanding debt. Basically buying up junk, okay? And they have these repos. They fell in their most recent balance statement from 185 billion to zero. That's very important. That means they're not carrying as much stuff on their books. So you can come down here and see where they went down from about 7.2 trillion to 7 trillion on their balance sheets. That's very, very important. This was one of the big criticisms of the Fed during the last downturn, during the 2008-2009 recession, is because they kept this money, they kept these balance sheets high. And the reason it's at 7 trillion is not just because of this pandemic, but it's also because of where we are right now and how much money they added back a number of years ago. So that's very, very important. So there's a couple of other areas of importance. So if you're just joining us, we're going over the Fed meeting minutes from yesterday. They just released this, and this is giving us guidance on where we're going in the future. over the next 12 months, what they expect Congress to do in the form of any kind of stimulus. Will they keep interest rates low? Where do they see the biggest problems in the economy right now? So some of those areas include the hospitality industry, the travel and leisure industry, hotels, airlines, etc. They expect more trouble in those quadrants, and that's why we saw the S&P yesterday. We saw stock market go just a little bit after this meeting minutes came out, and we started to analyze it. Okay, let's go through. There's some other areas of inflation that I also wanted to highlight here. I wanted to bring up on our chart here so you can see some of the periods of inflation. The consumer price index increased from 0.6% over 12 months ending in June, with core CPI inflation was 1.2% over the same period. Also, look at this area down here. This is important as well. University of Michigan surveys of consumers for the next 5 to 10 years was unchanged. That's a good 3-year ahead measure from the Federal Reserve Bank of New York survey of consumer that expectations went down in June. But it's not terrible, but consumer expectations went down. Look, we're going back to school. We're not buying as much stuff going back to school. Will consumers be buying? Remember, the GDP in this country is driven 70% by what consumers spend. So if we have little downturns in consumer confidence and consumer spending, that's not good. That's not good. Also, disposable income. Now, I was surprised by this because when they're talking about disposable income, you would think that disposable income would have gone up more because of the additional stimulus. But what they're saying is the real disposable income fell back in May because we were losing some of that additional stimulus payments. But, look, a lot of that still continued through June, so I'm surprised to see that. But they said wage and salary increased strongly in May as well. One big piece, this is a huge headline, folks. Another big piece of this is that employment gains that we were so excited about, people getting their jobs back, slowed since mid-June. But it's still strong. They're saying job growth is still strong, but it's slowed. So we're going to see here in the next few weeks. I'm really interested to see these August jobs numbers. We know it went down in July. What will August look like? Let me know in the chat, like how many of you are seeing, hiring signs in your neighborhood? How many people are hiring right now? When you drive through your local businesses, are you seeing more businesses shut or you see more businesses hiring? This is a very strong indicator of where we're going in this economy. And so again, those August jobs numbers, which we'll have the first week of September, will be the tail of the tape. All right, let's talk about businesses right now. And obviously the PPP loans that we're expecting to see over the next few weeks, if Congress can pass those additional stimulus. Right now, they're saying indicators here of business fixed investment suggest that investment has generally not begun to recover to match the pace of declines. Has not begun to recover. Now, what does that mean? Again, very important. That means that businesses are not necessarily investing in themselves right now. They're not buying the big heavy equipment that they need. They're not making the big purchases. They're waiting. So business fixed investment has not begun to recover. I'm not saying all business sectors, but in large part. Also, business spending on the non-residential structure outside of drilling and mining sectors also declined. There was a surge in manufacturing production, which is good, which was because of gains in the in automotive. So we have some good signs in the automotive sector. That's some good news. The mining sector also, which includes crude oil. That's an area that has decreased further. Look at this right here. So if you've got money in oil, or you're thinking that we're going back, right now we had a story in the newsletter that we printed the other day about big oil, and they're just not doing exploratory oil searching right now. Those big oil rigs in the ocean, they're not. They're pulling back on that because they're saying, why? we already have an overabundance of oil. We don't need to be going exploring, looking for oil wells right now, looking for new spots. People just aren't using it. People aren't driving as much. People aren't flying as much. And therefore, we could see a real change in our amount of fossil fuel consumption over the next few years. this move towards solar, the move towards electric cars. I mean, just look at Tesla, their explosive growth. They're now the US #1 auto manufacturer. Tesla, electronic cars. You see the surge of electronic car manufacturing coming out of China now as well. New Chinese manufacturers of electric cars to take on Tesla. This could be a sea change, folks. So if you've got your money tied to the oil industry, I would be very cautious of this and pay attention to what the Fed said yesterday. Very concerning. What about the overall, consumer sentiment right now? And so they have the staff review of the financial situation. This part really jumped out to me in this. So stay with me, folks. This is good stuff. I mean, this is very, very important stuff. Staff review of the financial situation. So this is looking at the financial market sentiment. It was boosted by better than expected economic data for the United States, China, and Europe. However, the boost to the sentiment appears to have been offset by concerns about the domestic spread of the coronavirus and its uncertain effects on the future of the course of the economy. So, specifically talking about the United States, the boost to consumer sentiment and overall financial sentiment appeared to have been offset by concerns over the coronavirus. That's very important as well. And if we don't get our act together, it's going to have global implications for us. Let's go down here. So it is 13 pages. I won't go through all of it. I'm going to go through some of the highlights here. We also had exports that decreased. Let's talk about inflation. This is the next area that I think is important to talk about. So despite the uptick here in both the 5 and the 10-year measures of inflation, they remained below their pandemic levels. So all concerns right now about us having explosive inflation, we're going to keep these rates and we're going to keep this area as low as we want, as low as we possibly can. And look, this is what Wall Street was trying to pay attention to yesterday. The market implied forward rates referring to the 2021-22 remain slightly negative. However, investors generally did not expect the meeting minutes to lower the federal funds target range below 0. So we're not going negative, okay? That means that yield curve might have gone negative, but we are not going to go negative, okay? We're not going to go to negative interest rates. Now, the Fed has repeatedly said we're not going to go low. We're not going to go negative. So important there. Let's look at some more notes here that I took. Let me go down a little bit. Let me go down to page 7 here. Let's see. Yeah, let's talk about the municipal market. Let's go down to page 7 and financing conditions for small businesses. That remains tight, very tight. And small business loan performance deteriorated significantly. Short-term delinquencies were compared with levels seen in early 2008. And this is troubling, folks. This is troubling because this is something they absolutely wanted to avoid. These loan deteriorations, these delinquencies from small businesses. We see small businesses closing left and right. Why is this important? This is important because they put this Main Street program in place to allow liquidity for small businesses. But boy, they have just not taken advantage of it. A lot of them just probably don't even know it's available. You know, if you walk down Main Street in your town and you go up to your little nail salon and you go to they probably don't even know about these programs. They've tried desperately to reach out to the Chamber of Commerce's and all across the country to try to get the message out to these small business owners. They just haven't gotten the message. And you're seeing these delinquencies rising, and that's just incredibly troubling. Yeah, let me just keep going through here. So they lay out a couple of different scenarios. This is important. Where we could go from here and their outlook on the future. So let's go down to page 8 in their meeting minutes. And they're talking about some different scenarios here, about really like 3 different scenarios, that they could see an acceleration in coronavirus outbreak. They could see another round of strict limitations on social interactions and business operations. And they think that this could happen later this year. And we would see another jump in unemployment rate. Wow. Digest that one for a second. This is one of the Fed's forecasts. Folks, I think that's probably, look, call me crazy. I think that's probably one of the most likely scenarios right there, don't you? That we have an acceleration of coronavirus outbreak, another round of strict limitations on social interactions and business operations that's going to start later this year, and a huge jump in unemployment. I mean, I don't know how else to say it, but I think that this is highly likely. Highly likely. Let's continue. Let's see. Let's see. So they're seeing inflationary rates could increase by 2021 and 2022. And yeah, what else do we have here? An overall consumer sentiment. So this is a big piece of this. This is where Wall Street really wants to pay attention to, is what about consumer sentiment? So let me go down here to the consumer sentiment page, and I just ask you in the chat right now, where's your head at on this? You know, for consumer spending, you saw less improvements in the business sector in recent months, high levels of uncertainty and risks in the market. This is a big one. Supply chain problems, disruptions in supply chains, certainly seeing that from Apple and other companies. We're seeing about delays. We could see an iPhone, release of new iPhones in the fall because of supply chains, but that's not just Apple, every major company. Challenges associated with closure and reopening, elevated employee absentee in some cases. Small businesses were under significant strain. And this is a big piece. I'm going to highlight this right here. Fiscal support was uncertain. Fiscal support was uncertain. Incredibly important. Okay. So that means that if these businesses don't know that they're going to have additional stimulus money, they're less likely to invest in themselves. If consumers don't know that they're going to have, if they don't know they're going to have more stimulus money, they're not going to spend money, which is the driver of our economy. Incredibly important. This is what Fed Chair Jerome Powell had been warning about. It's that uncertainty which can cause problems. It's not necessarily the virus itself, it's the uncertainty that causes problems. Other countries, though, have handled it much differently, haven't they? They've provided additional stimulus month after month. In Canada and other countries, $2,000 a month. Those people know that they're getting money every month, and therefore they're not uncertain. They will continue to spend. In the United States, we don't know. We don't know anything. We don't have any stimulus dollars. Go on to talk about low oil, still low oil demand, excessive inventories of oil. What else do we have here? Yeah, there's in prices, obviously, on food has gone up because of supply constraints. You've certainly seen that there's further concerns about food prices in this country. And one of the big pieces they say is can we reopen? This is a big piece of their consumer sentiment here at the bottom. They have 22 million job losses over March and April. That had some significant gains, so it helped offset it. However, participants generally agreed that the prospects for further substantial improvement in the labor market would depend on broad and sustained reopening of businesses. Yeah, well, good luck with that right now, because we've botched our reopening process altogether. So maybe we shouldn't have even opened. Here's another big piece of this, talked about the uncertainty because of the corona. I mean, it's all coronavirus stuff, folks. Dependency and fear of the course of this virus and the public sector's response to it. They're worried about additional waves of outbreaks could result in extended economic disruptions. Another possible fiscal support for households, businesses, state and local government might not provide sufficient relief for financial strains in these sectors. Brutal. And the list goes on. We're almost done here, folks, but this is important to go through. You're going to be smarter today when you sit down at your dinner table and you talk to your family. You're going to say, hey, I watched the whole show on the federal Reserve's meeting minutes, and I learned something. You learn where their head is at. That they have these different scenarios about possible closing up again, and they're going to keep interest rates low, down near zero, that they will not go into negative interest rates, and that they may start using benchmarks in terms of unemployment as a gauge of when we should increase interest rates, which is interesting. So looking at maybe dropping from 10 to 8 to 6% unemployment, that could have them increasing interest rates on a sliding scale. That hasn't been determined yet, but something that they're considering. You can see them having this debate in these meeting minutes. And this was a meeting. They're going back and forth deciding whether or not they want to do that. It's an interesting way to think about it. They haven't done that before. And what else here do we have? Okay. Now, this is a big one. The committee's perspective. They want fiscal policy support. Fiscal policy support would be necessary to encourage expeditious improvements in labor market conditions. Okay? They want stimulus. They want stimulus. They are calling for stimulus. Fiscal policy. Policy, folks, that comes from the federal government. Fiscal policy support would be necessary. Would be necessary. They want Congress to get their act together and pass stimulus. So they want to keep these interest rates at where they are in light of these developments, right around 0% to 1.25%. They want to keep interest rates right around there for the time being, and probably into the future, for about a year into the future. And they want to maintain the federal funds rate in that target rate of about 0 to 0.25%. They want to increase the system open market account here at their wrap up. This is sort of at the bottom here. Let me go down a little bit more. They want to keep it to about 0 to 1.25%. They want to increase the system open market account holdings of the Treasury securities and mortgage-backed securities. So what that means is, folks, this is what Wall Street was excited about also, is that they're going to continue to buy junk. They're going to continue to buy up these mortgage-backed securities. So again, the Federal Reserve is going to continue to provide stimulus to Wall Street. They're going to continue to prop up Wall Street. And they, in these notes, are calling on the U.S. Congress to pass fiscal policy that would provide stimulus for the American people, specifically in the labor market. Particularly in the labor market, making sure that people's wages, they're able to pay for their rent, etc. So they absolutely need to get their act together. Congress does, is basically, if you read between the lines here. And there you go. That's pretty much it. Let me just scroll down to the bottom here. Folks, I'm proud of you. We went through the entire Fed meeting minutes here, and now you have a deeper understanding of what's going on from the Federal Reserve. They see a gloomy outlook. One of their top scenarios is that we do go back into a further lockdown. Businesses will have to close later this year, and unemployment will go up. These are very important pieces of this. They call on basically Congress to pass fiscal policy that will continue to provide financial support for the American people. They see some strong gains in certain sectors like manufacturing, good gains in the job market, but it fell flat in June. And all eyes will be on this August jobs numbers report, which we'll see at the beginning of September. We'll get that August jobs report. What else? The big takeaway here, though, is that uncertainty remains strong. Uncertainty is the name of the game, and that's driving consumer spending down, consumer confidence, which is all the more reason that we need stimulus money. If Americans know that they have a continuous stream of stimulus cash, maybe from now until the end of the year, they'll be able to pay rent, buy groceries, buy back to school stuff for their kids, put money into the economy that is much needed right now. And yet we're not doing it. And of course, the news of the day is that GOP members of Congress want to pass this $500 billion skinny stimulus bill, much smaller than what we need. That it would include $300 for unemployment benefits, not the $600 that we had up until this point. It would not include stimulus checks. It would not include broad money for state and local governments. It would not include a payroll tax cut. It would not include student loan deferral monies. It would not include a whole host of things. So it would include money for the post office, They're using this as a bargaining chip for Democrats, and it would include $300 for unemployment benefits and about $100 billion for schools. That's about it. And coronavirus testing. That's about it. That's what Republicans are putting forward in their bill. So I hope that Congress is paying attention to what the Federal Reserve released in their meeting minutes and set guidance for the rest of the year. They're probably not paying attention to it, but I hope that you are and that you're getting smarter as a result of it. Remember, you can download and totally free. Get our free morning newsletter just by going to morninginvest.com. It's very simple to do. Go to morninginvest.com and you'll get that inbox, or you'll get it delivered to your inbox first thing in the morning. We put a lot of work into this newsletter. It's totally free, and you can read the news first thing in the morning on the stories that we think are important to you. That's really why we do it. We also would love if you subscribe to our channel right here and smash that like button on today's video. We put a lot of work into today's video and today's show to bring you the latest news on the Fed, the economy, the stimulus, the DNC, and more. So thank you so much for all of your support.